Welcome to another podcast of the Riffle series. The Riffle, a podcast series brought to you by 10 Leaves. I'm really thrilled you're joining us today for this deep dive because we're taking a look at something that, well, it quietly dictates how the entire global economy functions.
Yeah, it really is the hidden machinery behind the scenes.
Exactly. So our mission today is to unpack a pretty dense but incredibly important regulatory document. We're looking at the March 2026 Frequently Asked Questions, or FAQs, released by the Dubai Financial Services Authority. And this covers their anti-money laundering, counter-terrorist financing, and countering of proliferation financing regimes.
Which I know is quite the alphabet soup right off the bat.
It is a massive mouthful of regulatory jargon, but trust me, you need to know this because it acts as the invisible shield of global finance. But maybe we should briefly contextualize the DFSA first for anyone who isn't familiar.
All right, so the DFSA is the independent regulator for financial services in the Dubai International Financial Center, the DIFC.
The big hub.
The massive hub, yeah.
Yeah.
They oversee a huge high-stakes ecosystem. We are talking about major banks, wealth managers, NASDAQ Dubai, commodities traders,
And all those cutting-edge fintech startups popping up everywhere.
Exactly. If capital is moving through the DIFC, the DFSA is watching to make sure it's clean.
And even if you aren't sitting in a compliance office right now, you really should care about this document. If you have ever yelled at your laptop because your bank asked for your passport for the 5th time, or if you've wondered how international markets actually keep bad actors out of the system, this is the blueprint.
It is. It shows you the exact mechanics of financial safety.
Yeah.
This isn't just administrative red tape.
Okay, let's unpack this. Because right out of the gate, the document highlights how terminology in the financial world can actually be pretty deceiving.
It can, yeah.
In the DFSA's rulebook, when you see the term money laundering written in lower cases check, it's not just talking about cleaning dirty cash from a bank heist. It acts as a massive umbrella term that usually automatically includes terrorist financing and proliferation financing.
Which is a heavy term.
Right. I mean, proliferation financing is literally the funding of weapons of mass destruction, so it's a big umbrella.
What's fascinating here is the crucial exception to that rule. The regulator points out very clearly that there are times you have to split those terms up.
Oh, really? How so?
Well, they detail AML Rule 6.1.3. It says that when a business factor indicates a lower risk of money laundering, it does not automatically mean there's a lower risk for terrorist or proliferation financing.
Because they are completely different threat profiles.
Exactly. You can't just lump them together when you're evaluating a client. Think about a contract of non-life insurance. Let's say you are insuring a massive commercial shipping freighter.
Okay.
Buying insurance for that ship isn't a very practical way to launder millions of dollars of dirty cash. The mechanics just don't make sense for a typical money launderer.
Right. You don't clean drug money by buying a hull insurance policy.
Exactly. So the money laundering risk is technically low. However, what if the shell company that owns that ship happened to be tied to a sanctioned warlord or a state actor trying to move restricted weapons?
Oh, wow. Suddenly your boring insurance policy is a massive global security violation.
Right. The terrorist and proliferation financing risks are incredibly high in that scenario because of the sanctions exposure.
That makes total sense. And it goes the other way too, right?
It does. Consider private banking services.
Yeah.
You're dealing with high net worth individuals, complex offshore trusts, massive volumes of capital. By its very nature, it's a playground with a higher risk for money laundering.
Lots of places to hide cash.
Lots of places. But just because someone is trying to hide wealth from the tax man, it doesn't automatically mean they are secretly funding a weapons of mass destruction program.
Right. So the takeaway is that institutions have to assess these risks completely separately.
They do. Moving from the definitions to the actual day-to-day application, the document talks a lot about a firm's compliance culture. The DFSA expects a top-down approach led by the executives.
But how do these businesses actually measure this risk practically? I mean, culture's a buzzword, but how do you measure it?
It comes down to the relationship between the business risk assessment and the customer risk assessment, the BRA and the CRA.
Okay, so the business as a whole versus the specific guy walking through the door.
Precisely. You can't just copy-paste the overall business risk rating onto a specific customer. The methodology has to align.
Wait, so if a bank evaluates its overall operations and decides, hey, our business is generally a medium risk profile, why can't they just apply that baseline to a standard client?
Because a bank with a medium risk profile can still onboard a high-risk client. The regulator dictates that your customer assessment methodology has to reflect the same logic as your business assessment.
So if your overall business assessment flags say precious metals trading as highly sensitive,
Then your customer assessment better attach a high-risk rating when a gold trader applies for an account.
that makes sense. Internal consistency.
Right, and both of those risk assessments must also align with the outcomes of the National Risk Assessment, the NRA.
And that's issued by the UAE's National Committee, right?
Yes. So the national threat level dictates the business risk parameters, which in turn dictate how strictly you look at the individual customer.
Here's where it gets really interesting. Because we hear about all these high-level risk assessments, but what about the actual nitty-gritty of just figuring out who someone is?
Identity verification.
Yeah. The document addresses what to do when a customer has multiple names. Let's say someone uses an adopted name or they have a maiden name. How does a bank handle that?
The baseline expectation is absolute clarity on the present. Any current name used by a customer has to be independently verified. Zero flexibility there.
Okay, but what about the past names?
For previous names, the regulator is actually quite practical. They expect firms to employ a risk-based approach to mitigate any connections to past risky activities.
So making sure the old you wasn't running a Ponzi scheme 10 years ago.
Pretty much.
That covers individuals. But what about legal persons, companies? Can a bank just look up a company on a commercial database to verify it, like a quick search on PitchBook or Bloomberg?
No. The DFSA firmly clarifies that you cannot do that.
Really? Not even as a starting point?
As intelligence gathering, sure, but according to federal AML legislation, specifically Cabinet Resolution number 134 of 2025 and AML Rule 7.3.2, Section 3E, it is not a substitute for the real thing.
What is the real thing?
Obtaining the actual articles of association or equivalent governing documents is mandatory. Databases are not a legal substitute.
So they want you looking at the actual bedrock legal documents that birthed the company.
Yes, databases have lag times or data entry errors. You need the primary source material.
But if we're demanding primary source physical documents, that brings up a huge modern problem. FAQ 8 dives into this, the shift to digital onboarding.
It is a massive shift.
Right. Identity tech is moving at warp speed. People want to open accounts on their phones at 2 in the morning.
And the DFSA permits digital onboarding. They know it's the future. But institutions must use government-authorized systems where stipulated.
So if you are verifying an Emirates ID digitally, you can't just use a random third-party scanning app you downloaded.
No, you have to use the online validation gateway of the Federal Authority for Identity, Citizenship, Customs, and Port Security, or the UAE Pass application, or Emirates facial recognition.
The EFR.
Yes, it has to be the official pipeline. And if we connect this to the bigger picture, when firms do use third-party digital identity services for other things, they must conduct a risk-based assessment on the tech itself.
To make sure it actually works.
To determine the assurance levels, the reliability and independence of the tech. They are guided by Financial Action Task Force, or FATF, best practices on this.
To make sure it can't be fooled by a deepfake or something.
Exactly.
Okay, so we have all this incredible tech verifying IDs.
Yeah.
Let's transition from the automated tech back to the human accountability side.
The most critical part.
Let's say the system flags a potential client as a politically exposed person, a peep. Who actually gets to say, yes, we will take their money and do business with them?
Senior management approval is strictly required. That's laid out in AML Rules 7.3.8 and 7.4.1.
But who exactly counts as senior management here?
It must be an executive with significant responsibility for managing money laundering risk exposure.
And there's a really crucial distinction the document makes about who that cannot be right.
Yes, this is vital. The approval process cannot simply be automatically deferred to the compliance officer or the money laundering reporting officer, the MLRO.
Which honestly sounds a bit counterintuitive at first. You'd think the compliance expert is exactly the person who should be approving high-risk clients.
It does seem that way, but the business and risk-taking executives must own the decision. The people who want to bring in that high-net-worth client to generate profit have to take on the risk.
They want the people making the profit to feel the weight of the liability.
Exactly. The MLRO is there to advise and monitor, but the business owns the risk.
I love that. And this approval is needed not just to commence a relationship, but to continue it, right?
Yes, if a client becomes a BP, later on or during periodic reviews. Or, crucially, if a trigger event occurs.
Wait, what is a trigger event? Give me an example of that in the real world.
An unusual or illogical material transaction. Say you have a client whose business typically wires $10,000 a month for standard consulting.
Okay.
Suddenly, they attempt to wire $2 million to a newly formed shell company in a high-risk jurisdiction. That is a trigger event.
The system freezes it.
Yes, and senior management must step in, review the facts, and formally approve continuing the relationship.
So what does this all mean for third-party vendors? If a bank uses an automated tech solution for all this transaction monitoring, or they outsource their due diligence, are they off the hook if something goes wrong?
The definitive answer based on general module or GN rules is no. You can outsource the task, but you can never outsource the liability.
The firm remains entirely responsible.
Entirely. You can use automated systems for transaction monitoring, but firms must test them. They must understand their limitations and apply their own mitigation measures.
You can't just point the finger at the AI software and say it missed the bad guy.
Never. The regulatory action falls on you.
Wow. Which brings us to the final line of defense to make sure all of this is actually happening: internal audits and international sanctions.
Right. AML Rule 9.4.1 and Article 21 of Cabinet Decision Number 134 of 2025 require an independent audit function to test these anti-crime policies.
And how often does that happen?
The frequency depends on the size of the business regulatory feedback and the national risk assessment.
What are these auditors actually looking at, more than just the money flow, I assume?
Much more. The audit must examine the adequacy of training materials, how attendance is tracked, outsourced MLRO back-office functions, and suspicious activity report systems, the SARS.
Very comprehensive.
Yes. This raises an important question, though. How fast must firms react to global events?
Like when a geopolitical event happens and new sanctions drop.
Exactly. Chapter 10 of the AML module dictates firms must establish systems to comply with UN Security Council resolutions. Instantly.
Yeah.
If they discover non-compliance, they must immediately notify the DFSA. Following guidance like the Executive Office for Control and Non-Proliferation's July 2025 FAQs, the EOCN.
Immediate notification.
There's no off-the-clock in compliance.
To summarize this whole deep dive for you listening, what we are really looking at is an incredibly complex, fast-moving web of responsibility. Local UAE laws, FATF guidance, and UN resolutions all working together.
It's a very delicate balance.
It is. Cutting-edge technology and AI on one side to keep commerce flowing, and strict human accountability on the other.
And that dynamic introduces a final thought I want to leave you with.
Please do.
The DFSA clearly states that while automated technology and AI can be used for things like transaction monitoring and digital onboarding, the ultimate legal liability rests entirely on human senior management.
Right, the executive.
But if we rely more and more on AI algorithms that process millions of data points, a second acting as a black box that no human can fully read in real time, how will financial institutions of the future balance the mandate for cutting-edge digital efficiency with the inescapable weight of human accountability?
That is a wild thought. If an autonomous algorithm goes rogue and funds a sanctioned entity, who actually goes to jail? The executive or the engineer?
Exactly.
Something for you to mull over. Thank you so much for joining us on this deep dive into the invisible shield of global finance. We hope you walk away with a richer understanding of the mechanics keeping the markets safe. Until next time.